So during the worst of the pandemic, e-commerce gained 700 to 800 basis points of market share. And we think that that's going to normalize closer to 400 basis points as we get towards this new normal. But from this baseline, e-commerce companies will have a faster growth rate because they've gotten stronger through the pandemic. And if you look at e-commerce on a 2-year stacked basis, in fact, growth rates have doubled and tripled relative to what they were before the pandemic. So this multi-year improvement enhances value. And we think it will lead to significant improvements in equity values going forward. And the biggest online beneficiaries to us are those that experienced step function scale during the pandemic, were earlier along in their adoption curve in some cases, and cater to the small and mid-sized business community. So the names that we identified in the report included Amazon, Etsy, Shopify, Mercado Libre, and Sea Limited.
So given the Amazon, Etsy, Shopify, all at buy rating, it doesn't sound like you're that concerned at the moment about, say, Amazon risk, quote unquote, on some of the smaller players.
It's a big market out there, and I think that we're dealing with a lot of winners. And what's happening in the retail industry is that share is shifting, has been for well over a decade, from offline to online. And that's really accelerated by this period. So if you look at names like Etsy and Shopify and where they're really taking share from, it's from a lack of availability of strip mall distribution and craft fairs and things like that for Etsy. And for Shopify, it's really about transitioning, somewhat technology laggard small businesses onto the internet with their tools. And so you have an enhancement, I think, of the total addressable market through the improvements in those businesses, while Amazon, maybe on the margin is affected somewhat by the strength in a business like Shopify. But when you look at the bigger picture, all three are doing quite well.
Yeah, Scott, we were just talking about the FTC looking at M&A, and I can't help but think Amazon didn't crush Etsy despite the handmade stuff, didn't crush Stitch Fix despite getting into that space. It's partnering with a firm, not crushing it in buy now, pay later. And Shopify is doing just fine, sort of cooperating but also competing with Amazon. So what would happen to valuations in this space if the big names were sort of not allowed in an even greater basis to do M&A? I mean, I imagine it would have a private market impact, but maybe a public market impact too?
Sure. And, Netflix and Carvana and Wayfair and on down the list, there's a long list of companies that have been successful in a world where Amazon dominates. I think there are some areas that, have been negatively affected very clearly, those names that are in the wasteland now of the retail marketplace. But what it does is it really takes away, the possibility for these smaller businesses to sell into larger companies in consumer technology, the way that, historically there was more of an option on those businesses. So it's much more likely that you're going to have more independent companies just because of the constraints put on these larger businesses and a more competitive, marketplace for that reason.